Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to save you money. My job, not just to entertain, but to put everything into context. So call me, 1-800-743-CNBC. Tweet me at Jim Cramer. When you've moved up as much as we have since the post-Liberation Day lows, you better hope that earnings can justify that run. Today, though, the earnings came up short. While there were many bright spots, there were enough negatives to offset any talk of a potential trade deal with China or the strength of the economic data or the continual parade of takeovers that would have been blocked by that previous administration. They wouldn't even thought about doing them. And that's why the Dow lost 205 points, the S&P dipped 0.3%, and the Nasdaq declined 0.38%. In fact, on the eve of a wait-and-see Fed meeting, there was enough negativity about some parts of the economy, especially the consumer, that you might wonder if Jay Powell should simply do what the president wants and cut interest rates. Only some strength in a handful of industrials and techs seem to cut in favor of standing pat today. You know what? That might not be enough. Let me start with the negatives because they are visible, they matter, and they cut President Trump's way. Today, three very big household name companies reported jarring quarters that made me feel like the stock market's becoming divorced from some real problems out there, problems that should have been obvious given all the tariff turmoil. Consider the following from Carol Tomei, CEO of United Parcel Service, after reporting a dismal quarter. Quote, despite uncertainties around trade policies in the second quarter, the overall economy remained resilient, end quote. Hold it, just a second. Here we go. Quote, but our sector, specifically the U.S. small package segment, was unfavorably impacted by U.S. consumer sentiment that was at historic lows, end quote. Wow, very bad. Historic. A win for the president in his tiff with the Fed. It gets worse. Quote, on the commercial side of the economy, manufacturing activity in the United States remains soft, end quote. Average daily unit volume declined by 7%. Now, I know that UPS had its problems. Its profitability has been hurt by the labor agreement the company reached 2 years ago. Its pivot to cut dependence on Amazon traffic hurt. But Big Brown is a huge company that controls a major chunk of American shipping. So when its stock plunges more than 10%, I regard that as frightening. Not only did UPS present plenty of evidence of a weakening consumer, it also documented how the tariffs are already beginning to hurt consumer sentiment and consumer spending. Now, it kind of took my breath away when CEO Tomei pointed to some very strong business between lots of countries that did not include the United States. It was among the first quarters where I heard the damage that's being done to American commerce by our tariffs, damage that's not being replicated in country-to-country business that are not impacted by new tariffs. Alas, but UPS wasn't the only one. Whirlpool, which was supposed to be helped by the tariffs, at least eventually, instead got walloped by them. I crushed ugly. Whirlpool's last man standing when it comes to appliances, the only one that's still domiciled in this country. But the big appliance makers from South Korea and China, they're not dummies. They knew they'd struggle with the tariffs on their countries. So they front-loaded their inventory, shipping lots of appliances here ahead of time. The result? The foreign onslaught crushed Whirlpool. Sell. It reported an astonishingly weak quarter, taking its earnings forecast down from $10 per share to the $6 to $8 range. Worse, they took a meat axe to their dividend, cutting the quarterly payout from $1.75 per share down to a shocking 90 cents. Let's call it a collaterally damaged situation because tariffs were meant to help Whirlpool. Instead, they blew up the dividend, which, when you include a dismal outlook, is why the stock was down an astonishing more than 13% today. Oh, and if that wasn't enough, Stanley Black & Decker, another name. Look in your house. You've got these really just, whoa. It shocked me. A weak consumer who seems to have backed away from do-it-yourself projects, coupled with inevitable $800 million tariff hit as the company imports a huge amount of product from China and the so-called reshoring safe haven of Mexico. It took my breath away. As I read over the quarter, all I could think about was that Stanley Black & Decker is the kind of company that President Trump was trying to punish for moving too many jobs overseas. That's some real punishment, with the stock down 7% today.
The House of Pain.
UPS, Stanley Black & Decker, Whirlpool. They form a trio of well-known household companies that tell me this economy might be substantially softer than we think, at least in part, when it comes to consumer and some heavily tariff businesses, which means the Fed might really need to think about cutting rates to offset the damage and cutting rates sooner rather than later. These companies are experiencing the true worries we had about the tariffs while they were being slapped on earlier this year. It's entirely possible that the negative effects are one-time only and will go away as we get more trade deals. But right now, we're in the thick of it. You know what? It just doesn't feel good. And honestly, it's hard to dismiss them as one-off when even fintech giant PayPal revealed slower growth in payments, blaming tariff fears. The chief financial officer, Jamie Miller, said, and I quote, "We observed a slight softening in retail spending in the U.S., most apparent in areas likely impacted by tariffs," end quote. After all the robust consumer spending we saw when the banks reported 2 weeks ago, I was surprised by the news from PayPal. So was the market, with the stock falling more than 8%? I say, ouch.
The House of Pain.
When you rally as hard and as high as we have, you really can't afford to see this kind of weakness. Today's earnings made me feel like we'd forgotten the impact of all the tariff turmoil on the consumer. Some of the decline, I think, was an overreaction. Royal Caribbean went down on its outlook, but I got to tell you, I checked that one out. I think the expectations simply got too high. People got used to this cruise line just crushing the high end of the estimates. Didn't happen. Now, I felt the same way about Boeing. Now, here's a stock that just hit a 52-week high after giving you almost a double from its low in April. Thank you, Kelly Ortberg. And even though it reported a great quarter with beautiful cash flow, the stock still got hit today. But unlike all the others, just call me a buyer of that one. The rash of takeovers didn't for once sour. It didn't create any buying, and not even Union Pacific buying Norfolk Southern, truly creating a continent-wide railroad colossus, assuming the deal gets approved. Now, that's much more likely under Trump than it was under Biden, but there are legitimate antitrust concerns. I think they will get the deal done, but not for a long time. Hence why Target Norfolk Southern saw its stock drop $8.72, although it's still up nicely from when my colleague David Faber broke the story a few weeks ago, when you could still profit from it. Or Baker Hughes buying Chart Industries. GTLS, a very large facilitator of capital goods, including those connected with the selling of LNG, liquefied natural gas. That didn't help either. Nor did the potential combination of Palo Alto Networks, Nikesh Arora, Cramer fave, and CyberArk, a one-time Cramer fave, which is an Israeli cybersecurity company. Not even the incredible earnings news from Cadence Design Systems, also a fave of the show, and Celestica could help things. Cadence, a good partner of NVIDIA, blew away the numbers with a tremendous quarter. But who cares? I mean, we knew their business was great. Same with Celestica, which along with Sanmina and Flex, belong in an elite camp of contract manufacturers devoted largely to tech. They have more than their fair share of orders. It's a great time to be in that line of work, as we know when we had Flex on recently after their amazing quarter. Long story short, today was a wake-up call. The tariffs, even reduced tariffs, are starting to roil things. The consumer's not spending as much as I thought. There's an acknowledged slowdown there. The bonds, that's right, interest rates are signaling the same. Rates are going down. But how much of that slowdown is because of higher prices, something that bolsters a wait-and-see attitude from the Fed at tomorrow's meeting, and how much is because the consumer's worried and insecure and needs a rate cut? Bottom line, I think it's a mixture of both, but that mixture might not propel the Fed into action. Without a rate cut, though, we could see more quarters like we got from UPS, Whirlpool, and Stanley Black & Decker, all of which are a heck of a lot more important than a Cadence or Celestica, and all which are crying that a rate cut must occur sooner rather than later. It's a conundrum that makes me think the Fed Chief Jay Powell's in a real pickle when he speaks tomorrow. I want to go to Dina in Kentucky. Dina!
Jim Cramer, I'm so excited to talk to you. I'm new at this. I just started in August, and I'm really old, and I have to play catch up on my retirement. And you're
really old. Let me tell you, I got you beat on that. I know that. I mean, don't even go there. All right, what do you got?
I'm so excited to talk to you. Yesterday, you were just so on fire. I just loved it. I laughed all day long. But listen, my question is...
yesterday I was an arsonist. Oh, okay.
It was awesome. I laughed all day. My question to you, I was so far up on Netflix, so far up, And now I just hear that it's flattened and it may not go anywhere. And I just need to know from you, should I buy more or should
Look, Dina, let me tell you, this is an anecdotal stock. And I think right now people feel like, I don't know, Netflix, what's on? Nothing. I was watching Amazon last night, for heaven's sake. So that's what I think is causing it. Don't worry, it's going to be fine. They're smart fellas. All right, I think the earnings today was a wake-up call. Whether the Fed thinks so, I don't know. We got to wait and see. Mad Money tonight. Merck reported earnings that beat expectations, but the stock fell. What gives? I'm checking with the CEO. Then I'm digging into a new web-based design IPO launching this Thursday, and it's called Figma. I'll give you everything you need to know. And Waste Management, now called WM, beat earnings expectations earlier today. I'm seeing what the CEO has to say about the positive quarter and the stock's forever strong reaction. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
What do we make of the numbers that we got from Merck this morning? The Pharma Titan reported what some thought was a mixed quarter. I actually liked it. Small revenue miss paired with an 11-cent earnings beat. Stock got hit, finishing the day down nearly 2%, although it was a lot lower than at one point. Merck's had a tough time over the past year, falling 45% from its highs in June of 2024, but recovering only modestly over the past couple of weeks. Wall Street seems to be worried about that looming patent cliff for their blockbuster patent cliff, best drug ever, Keytruda, which accounts for about half of the company's sales. Doesn't help that Gardasil, their HPV vaccines, really struggled thanks to persistent weakness in China. We got to drill down on that. While Merck's made some excellent acquisitions to expand the drug pipeline, the stock hasn't gotten much credit for it. I think that's wrong. Let's check in here with Rob Davis, the chairman and CEO of Merck. Get a better read of the situation. Rob, welcome back to Mad Money.
Well, great, Jim. It's good to see you again. Thanks for having me.
Of course.
I really appreciate it.
Of course, Rob. Thank you. Now, before we get into some of the nitty-gritty of the quarter, I saw that the numbers from Keytruda were excellent again. Winrevair, which you and I have talked about multiple times, the treatment for pulmonary arterial hypertension, it's proved last year it's already reaching a $1 billion in sales run rate. Tell us about some of these insights, because there's quite positive news here.
Yeah, well, no, I appreciate that. Obviously, you mentioned about the quarter. I think it was, we had a solid quarter, $15.8 billion in sales. Strength in oncology, as you mentioned. Animal health did quite well. And really, importantly, increasingly our growth is coming from new products. You mentioned Winrevair, and also we launched Capvaxive. So we're really on the precipice, frankly, of a wave of new product launches coming. We have over 20 new products that we'll be launching over the next 5 years, including the two we just mentioned. But on Winrevair itself, this is an important therapy. We've had great additional data readouts. We recently had a positive data readout from the Zenith study, and then most recently from the Hyperion study. And what is so important about that study, it showed that in patients in their earlier stage of disease who are on less therapy, still significantly benefited from Winrevair. So this is important as we continue to see the evolution of this drug as an important therapy to address what, as you mentioned, is a devastating disease. So we're excited about what that can be, but excited about the pipeline we have coming.
Could you put, let's say, into the parlance of just regular people, how it's possible to have a drug reaching $1 billion in sales in just over a year? I mean, this is an extraordinary thing for a new drug to do, right? Yeah,
and it's cumulative sales over the first 15 months to get to $1 billion. And I think what it really speaks to is the meaningful impact this drug is having for patients. Pulmonary arterial hypertension, we've talked about this before, is a devastating disease. Almost half of the people who face this, many in the prime of their lives, many who are women in the prime of their lives and in childbirthing years, face this. And so the fact that we can now potentially extend their life through this drug and give them meaningful quality of life is why I think you see it do so well. And it really speaks to the strength of the science and the strength of the benefit to the patients. And that's what, as Merck, we're always focused on.
Okay, thank you. Rob, can you speak to me about these ongoing issues with Gardasil in China? This is an incredibly important drug. I would think a country would want to be sure that everybody had the option for it, at least the opportunity. But something's going on in China that makes it so that the demand continues to be soft. I don't get it, Rob.
Yeah, well, it's an interesting situation we faced in China. As you know, last year we saw a significant slowdown in vaccinations happening there with Gardasil. Our market share in the private market has largely held pretty much stable, but what you're really seeing is just an overall softness in the market, and in continuing to try to understand what's driving that demand. I do think a lot of this is a cash pay drug in the space we play. The economy continues to struggle, and people are making choices with their dollars, and unfortunately, they're not prioritizing vaccinations. But for us, the story is much more about what we're seeing globally with Gardasil, which is continuing to do overall well and grow. And frankly, as we look at the total company, we're moving to a period as we get to the back half of this year where we're going to be returning to growth, because we'll be lapping increasingly that effect of what you saw in Gardasil China last year. For the full year, we expect Gardasil actually to show growth this year, and we continue to expect good growth going forward for the overall franchise. So it's an important franchise. HPV vaccination is the simplest way to avoid cervical cancer. I always say the best way to cure cancer is never to get it in the first place, and that is what this vaccine does. So we continue to try to tell the story, to beat the drums for why everyone should be vaccinated, because it's an easy way to prevent cervical cancer for yourself and or for your loved ones if you happen to be a male. And increasingly, it also is showing and now has indications in head and neck cancer, which is also important because that's actually a growing cancer and it affects males much more than females. But for us, this is just one part of a story that's really about the broader, growing, diverse pipeline of opportunities we have across cardiometabolic, continuing to show strength in oncology, and really to start to position us to go post Keytruda and transform the business to be more than just a Keytruda story, but to be truly a diversified pharmaceutical company driving growth and benefiting patients. And that's really what we are all about, and where I'm starting to really pivot my efforts. And one thing I just want to quickly mention, I'm sure you'll bring it up, but we're very excited about the acquisition of Verona.
Right.
$10 billion deal, brought in Ohtuvayre, an important new mechanism of action, first one in 20 years for people facing chronic obstructive pulmonary disease, or COPD. So another important addition to the armamentarium we have, and a multi-billion-dollar potential drug in a period where we're really looking to drive that kind of growth. So really excited about what that can be as well.
Very good idea. Now let me just ask you one last thing here. You have some of the finest vaccines in the world. We think of you as just being the most pristine company when it comes to these things. Are you worried about the FDA slow rolling or blocking new vaccines, given the fact that yours are both life-saving and so far that I can ever tell about as safe as I've ever seen a vaccine?
Yeah, we continue to be quite confident and have strong belief in the safety and efficacy of the vaccines we're bringing to market. I will say, actually, clesrovimab, which is it's a monoclonal antibody, but it operates similar to a vaccine for RSV. We just got FDA approval and did receive a positive opinion from the ACIP. So we're excited about that. So they are continuing to take action, I think, when they see good science. And we're very excited about what that can be, because RSV continues to be a really tough disease, and particularly as it faces children in the first year of life, which is where we are focused.
Well, Rob, look, thank you for coming on again. I think that when Gardasil laps, boy, it's going to be terrific. There'll be no negatives, and you're dealing very well with the patent cliff. I think Keytruda is just one amazing drug. It's not going away. Anyway, that's Rob Davis. He's the chairman and CEO of Merck. This stock is very inexpensive. Rob, thank you for coming on the show.
Great, Jim. Thank you very much. Appreciate it.
Mad Money's back after the break.
Coming up, Cramer's giving you his take on the Figma IPO ahead of its debut and whether it's time to buy into the AI name. Next.
Ooh, later this week, we got a big IPO coming. Figma, the design software company, is looking at an initial valuation in the neighborhood of $20 billion, making this the largest enterprise software deal since 2021. Now, my gut says that this stock should be able to roar right out of the gate. But you know what? I'm hesitant to recommend it, even though the underlying business is excellent, because I'm betting it'll quickly get way too expensive. Now, if I'm wrong, you got my blessing to buy this one, because this is some great company. But only on weakness, assume we get any. See, Figma makes design software that's as ubiquitous as it is invisible. If you've looked up directions on Google Maps, if you booked a ride on the Uber app, search for flights from JetBlue, stream shows on Netflix, try to use Duolingo to learn a new language, or networked on LinkedIn, do you know that you've used a product that was designed with Figma software? They already have 95% of the Fortune 500 as clients. Basically, this company has a whole suite of software that makes it easier for their clients to design apps and websites, and their product is so good that, well, Adobe tried to buy the entire company a few years ago. Who could blame them? Blocked by antitrust. You can tell by looking at the numbers. Last year, Figma put up 48% revenue growth, although that sold to 46% in the first quarter of this year, and somewhere between 39 and 41% in the second quarter. These guys have more than 10,500 customers paying more than $10,000 in annual recurring revenue, ARR. That's how you measure this kind of company last year, up 45% year over year. 963 customers paying $100,000 in annual recurring revenue. And these numbers have both grown nicely this year as well. Now, Figma's net dollar retention, which measures how much money a software company's existing customers spend versus the previous year, came in at 134% in 2024, up from 122% in 2023, and only slipped to 132% in the first quarter of this year. That means their customer base keeps giving them additional business. Loved company. Best of all, Figma's actually profitable. Last year, their operating income grew by a staggering 369%, and the first quarter of this year was up 122%. Based on the preliminary second quarter numbers, that growth seems to have slowed, though. Free cash flow looks very nice. Now, I could talk about this thing, I like to talk about called the Rule of 40. This is a back-of-the-envelope way to judge enterprise software companies. You take the revenue growth, you add some version of the profit margin, and if the sum is above 40, you get a solid business. With Figma, we don't even need to do any arithmetic, because even in the latest quarter, the revenue growth was around 40%. Operating margin, positive. Rule of 40, excellent. So the numbers look pretty good here. But beyond the numbers, there's some issues. The first thing is I'm watching is what will prevail when two contrasting themes collide with this Figma deal. On the one hand, we've had a white-hot IPO market these past few months. A few real huge winners like CoreWeave, Circle Internet Group. You see that today? Wow. But plenty of more modest winners, too. On the other hand, even though tech's been doing well, enterprise software specifically has been pretty weak, maybe the weakest of all areas of tech. And some of the software companies that make tools for other software developers, they've really struggled, particularly software as a service or SaaS companies. Of course, the best comparison for Figma is Adobe. And we know that because Adobe tried to buy Figma a couple of years ago, announcing a $20 billion acquisition in September 2022. I thought it was so brilliant, before eventually throwing in the towel at the end of 2023 after the regulators on both sides of the Atlantic refused to approve the deal. Unfortunately, Adobe hasn't been doing too well lately. The stock, by the way, is down 41% from its recent high set early last year. Figma has much better revenue growth numbers than Adobe, but Adobe's much more profitable. In the end, if this market doesn't like Adobe, you got to be at least a little worried that it won't like Figma either. And look, let's talk about why enterprise software is doing so badly. It's because this industry could be the first victim of new generative AI technologies, which have proven to be very adept at writing code, even from very simple text prompts. Adobe has some solid AI offerings of their own, but the newer AI companies, they keep rolling out products that can be they do basically the same thing in a much, let's say, more basic, less artful way. Now, Figma does have some of its own AI technology at this point, but CEO Dylan Field also noted that, I'm going to quote, AI spend will potentially be a drag on our efficiency for several years, end quote. And that makes me worried that the company might take a real hit to profitability for an extended period of time. Now, I recognize the need for these companies to spend fortunes on AI, but if Figma's operating margin goes negative, well, I don't think Wall Street's going to be too forgiving, frankly. At the same time, I am not thrilled that most of the proceeds from this IPO, roughly two-thirds, are going to existing shareholders, not the company itself. Figma expects to bring in $360 million from the deal, and they plan to spend nearly all that paying down debt. I like that, not paying for investments that could grow the business. I would have wished that they got that more. Now, there's nothing wrong with keeping your balance sheet pristine, and these guys don't really need the money. But you know what? I always notice when insiders are looking to sell a ton of stock, right as they're asking new investors to buy them. Throw in the fact that Figma was willing to sell itself to Adobe for $20 billion a few years ago, it makes you wonder just how optimistic management is about the future. All that said, based on the strength of the IPO market and the quality of Figma's numbers, I expect this deal will be very well received by Wall Street. In fact, that's already the case, as the book runners, the people who manage the deal, had to raise the price range for the deal last night, taking it from 25 to 28 all the way up to 30 to 32. Wow. There are reports that this IPO is approaching 40 times oversubscribed, even at the higher price. I get it. Figma is a loved product, according to everyone I surveyed. Using the new high end of that new price range and making some assumptions on what to include in Figma's fully diluted share count, this company will have an implied market cap of roughly $19.4 billion. So if the stock pops a little bit from there once it starts trading, it'll be worth more than the $20 billion that Adobe was willing to pay almost 3 years ago. Is that reasonable? Should you be looking to get into the stock around that level? Well, let's assume a 40% revenue growth rate for Figma this year, which is below the first quarter's growth rate, but around what they did in the second quarter. In that case, the company would have just over $1 billion in sales this year, and the stock could be valued at roughly 20 times sales, not earnings. Sales, if it rallies a bit from the high end of this price range. Adobe, the closest comparison, trades at less than 7 times sales. Even when screened for software companies with 30% plus revenue growth, that elite group mostly had price to sales ratios in the teens. Only the hottest of the hot, Palantir Technologies, comes in above that level. Could it happen for Figma too? Maybe, but I don't think this one has that Palantir magical elixir. Although I think Figma's going to be steaming hot. Plus, there's been a scarcity of quality deals, and the market will most likely go nuts when it gets one like this. So here's the bottom line. There's a lot to like about Figma, the company, but it's already coming public at a pretty expensive level. And if the stock roars right out of the gate, I'm going to tell you, it'll be too pricey for me, even as I think the company's got a tremendous product at a very reasonable price. Let's take questions. Let's go to Jacob in Alaska. Jacob.
Hey, Jim. I wanted to get your thoughts on a company that recently had its IPO with shares doubling right out the gate, only to give back a good chunk of those gains after the initial euphoria wore off. Considering all the interest in the sector and increase in space and defense contracts, what are your thoughts on Voyager Technologies?
Okay, that did come out too hot. This is a good example, and I'm glad you're bringing it to our attention. It's a good example. It's just soared, but now it's coming in softly. My experiences, now this is my experience, not what anybody said to me about the level, but my experience is this is precisely when you want to start a position in Voyager. You buy it slow. You want to buy 100 shares, pick up 25 here, and then wait till it falls another 5, and just can keep it that level, and you'll have a great position. All right. I think the Figma IPO is one to watch. But if it moves any higher than where it's priced now, it's going to be too expensive for me. I know people still go for it, but I'm just telling you, for me, too expensive. Much more money ahead. Could trash bring you treasure? I'm checking in with the CEO of WM, fresh off its earnings to make sense of the stock's comeback and the runway it sees ahead. Then, I'm often asked about what deregulation really means for the economy. You know what? I'm going to tell you. I see it. And so I got to tell you, I like it. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Last night, we got an excellent quarter from WM, the garbage disposal operation / provider of comprehensive environmental solutions, formerly known as Waste Management. This company delivered a healthy top and bottom line beat, driven by strength in the core business, along with mostly positive guidance. That's why the stock jumped more than 3% today, when the few that I have it really look great. This one's important because the garbage business can actually give you a great read on the economy. So let's take a closer look with Jim Fish. He's the CEO of WM. More. Mr. Fish, welcome back to Mad Money.
Thanks, Jim. How are you?
All right. Now, Jim, I got to tell you, I typically do not do this, but I have to congratulate you for saying something that really made my day. You called your stock a forever stock. We used to have some of those. We don't anymore. What makes a forever stock?
Well, I think it's a stock that performs well quarter in and quarter out, year in and year out. And I would tell you over the last, decade or so, we've done exactly that. So I think investors should look at it as a stock that you buy and hold indefinitely.
Well, I think that some of the reasons why is because you've made acquisitions. Some people call them tuck-in. I disagree. You bought Stericycle. That turned out to be a fantastic acquisition that certainly doesn't seem to have any, that seems to be completely resilient to the economy.
If you look at the aging population, I think I read somewhere that in 1980 we were 29 years old and now we're 39 years old. So, it seems like a kind of a normal path, secular trend, I guess, that you would take advantage of. And that's exactly what we're doing with that acquisition.
Well, it was fantastic. Healthcare Solutions, EBITDA margins in the Healthcare Solutions improved 170 basis points. You actually raised your gross margins pretty much everywhere. How are you able to consistently do that?
The business, the core business itself continues to drive gross margins in addition to what you just mentioned with Healthcare Solutions. At the same time, we had a bit of kind of headwind as well, but the business overall is doing so well that it was able to overcome some of the headwinds. The core business, whether it's whether it's pricing, whether it is cost control on both the operating expense line or the SG&A line, both of those continue to really perform well, and therefore the raise in our margin expectations.
Well, it's terrific. I also felt that there'd be a time when I would interview you or your predecessor, and if commodity prices declined 15%, we would have had to explain why this hurt the business. It didn't.
So my predecessor is running the post office now, so hopefully he's paying attention to this.
How about it? That's why I thought of it. He's got a great job. He's going to make that thing work, isn't he?
I think he is.
But the recycling, he even talked about that when the Chinese pulled the rug from under waste management. Then it hurt, but not now.
That's true. And years ago, we were pretty susceptible to these big fluctuations, big peaks and valleys in the recycling business. We've really smoothed that out by putting some things in some of these contracts that protect us a bit. And at the same time, while the recycling business has grown, other parts of our business, like the healthcare solutions business, provide a little bit of a natural hedge.
Definitely. Now, Jimmy, help me. I've been trying to figure out what to do if I were Fed chairman. And not only mostly because David Faber, my colleague, says I'm going to get appointed. I don't think that's true. But I feel like that you would give me a good view about both the consumer and industrial, because you do a lot of stuff in residential, because the residential seems a little bit weaker. I would understand the president's position, but industrial doesn't seem all that bad. I understand the Fed's position.
The residential business is really not driven as much by the economy. It's really driven by kind of population, and the piece of the economy or the piece of the business that really looks like it's driven by the economy is our commercial business, our industrial business, and then on the landfill side, our municipal solid waste, construction and demolition, and really all of those are either very healthy or improving from where they've been. So while I'd love to see a rate cut, I'm not sure that the economy is weak at this point. In fact, it looks like it's strengthening to us.
You and me both. This is what's so difficult. I know yesterday on air, I kind of got a little bit too exuberant, but this is the big Fed conundrum, which is that what you just described. I think some stuff is definitely getting better. Some industrial stuff is just plain out strong.
Our construction and demolition business is probably the business that best indicates what things are going to look like going forward. And sequentially, that continues to improve. It's improved every quarter for the last 4. This was a very strong quarter in Q2, and the month of June itself was the strongest of the 3 months in the quarter. So I do think the economy is starting to show some real signs of improvement.
Now, how about the California economy? 1/5 of the country. I know you had wildfires there. Hard to determine how well or how poorly it did.
I mean, our California business is very important to us. It always seems to do reasonably well. This year, it was we were impacted by the cleanup, and we participate with these communities in cleaning up after natural disasters, and certainly the fires were no exception. We do the same whether it's in Florida with hurricanes or the Midwest with tornadoes or whatever the case is. So the California business was actually up a bit this year because of the fire cleanup. We certainly don't like to see those things happen, but when they do happen, we're good partners to our communities.
One last question, Jim. I actually have friends who are in your industry, but they're much smaller than you are. The regulatory problem for them is very, very difficult. They have to spend a lot of money to do it. Their margins go down. Sometimes they just leave the business. Increasing regulatory requirements for you, as you mentioned, page 18 of your deck, they actually work in your favor to some degree, don't they?
To some degree, I think that's right. You and I have talked about that in the past. It's, we kind of self-regulate above the minimum, and so what we've said is that regulations to an extent. I mean, look, if you close down landfills, that wouldn't be good for us, but we regulate our landfills at a much higher level than is required, and so. To some degree, added regulations work in our favor.
Well, you do have declining landfill airspace availability. You mentioned that landfills expected to close in the next 15 years. Yeah. Quite a few, 400.
So the entire industry is seeing a decline in landfill airspace, and it really starts to ramp up this year. So if you look over the next 15 years, landfill airspace does decline quite a bit. We're in an advantaged position there because in 9 of the 10 biggest MSAs in the United States, we have the best located landfill, and we have longer lives to those landfills. So that ends up being a positive for us.
Well, I got to tell you, I think that your commercial works really great. The one where it looks like, it's a nice park, and that people should realize that it's not the end of the world when a landfill ends. Sometimes it can look pretty darn good.
Yeah, absolutely right. You're right about that.
Well, anyway, thank you so much. Congratulations. It is a forever stock. It's a great term because we don't have many of them anymore. That's Jim Fish, WM CEO. Thank you, Jim.
Coming up, Cramer takes your calls. And the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the lightning round. Chris Memphis, Ralph Colson, and the stock by sell by top players. Play the sound. And then the lightning round is over. Are you ready? Ski Daddy. Time for the lightning round. Chris Memphis with Mira in Texas. Mira.
So excited to talk to you, Jim.
Right back at you.
With the new deal with Japan, is there a catalyst for Toyota Motor Company?
Well, I think they now get the downside, which is they're going to have to raise prices a little. I'm going to take a pass on Toyota only because it just went up so much, but I like your instincts. Let's go to Dave in New York. Dave!
Jim, what's going on, my man? Dave from New York.
Checking things out.
A quick shout out to my man Tommy Costa and Bob Benazzi. Just calling to see what you think about Advanced Auto Parts.
I'm going to say no to Advanced Auto Parts because I'm going to say yes to AutoZone. Get into the zone, my friend. Let's go to Mike in Pennsylvania. Mike.
Hey, Jim. Happy big booyah from the Lehigh Valley, PA. How are you?
Oh, man, I love that's where we used to practice. I love you. What's going on?
So, listen, I have a position already in Palo Alto. My question is, I'm looking to add to the cybersecurity arena, and my question is, what do you think about Fortinet? FTN?
No, we don't want Fortinet. We're going to wait till CrowdStrike reports. It's going to go down because that's what always happens, and then you're going to snatch some CrowdStrike. Let's go to Dan in Missouri. Dan.
Hey, Jim, this is Dan from Missouri. This stock had recent fantastic gains, gave fantastic guidance. What do you think of ServiceNow?
Well, I think the multiple's a little high, and I'm starting to get away from that kind of enterprise software. It's beginning to it's going to wear on me. How about that? It's wearing on me. All right, let's go to Mike in Pennsylvania. Mike.
How are you doing, Jimmy? Nice to talk to you. I'll get right to it.
What's happening?
I got to stop UGI. Comes out of King of Prussia.
King of Prussia. Come on, Upper Merion. I crushed them. But I'll be a buyer of the stock, most certainly. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Cramer is talking all things energy and how deregulation could be a major boom for the U.S., both overseas and at home. Next.
People often ask me what deregulation actually means to the U.S. economy and your investments. It's like there's some amorphous notion that deregulation might do something, but who knows what and why? How does it really help? Well, it depends on the industry. But we're getting our first real sign of the positives from deregulation, and it's a lot more straightforward than you might realize. Take what's happening in Louisiana and Texas. Right now, our country's been building these massive liquefied natural gas export terminals so we can ship the stuff overseas. It's monumental. We have anywhere between 40 to 60 liquefaction trains that are operational or under construction. These are gigantic efforts. Each train, a technical name for the processing unit, costs as much as $4 to $5 billion. The payoff's huge, though, because natural gas is much more expensive overseas. So to export, it's quite lucrative. We are the world's largest LNG exporter, but we have the capacity to produce a lot more, as we are the largest repository of natural gas. We just don't have all the pipe and trains to transport it. In theory, we could produce enough to wean Europe off Russian natural gas, which was part of the trade deal that the president just worked out with the European Union. They committed to spending $750 billion on American natural gas over the next 3 years, which is staggering, given that we only sold Europe $76 billion worth of fossil fuels last year. That's all fossil fuels, not just natural gas. Is that even possible? Okay, here's where the deregulation comes in. We currently send a lot of our liquefied natural gas to Europe, but Japan, China, and South Korea, they're also big clients. We need a lot more capacity if we're going to meet the new demand from Europe. We need to put up more trains. I wouldn't be surprised if we actually double our current capacity. Unfortunately, in January of 2024, the Biden administration imposed a temporary pause on approving these new LNG terminals. They wanted to study the environmental impact. While the administration regarded the ban as temporary, the Wall Street Journal opinion section called it a political ruse, assuming that it would be permanent, curtailing a robust fossil fuels industry dramatically. Either way, the pause on approvals froze the entire industry, and it called into question whether there were even enough LNG terminals to help our current clients. Many plants were put on hold, others were scrapped. But then Trump won the election, and you know what? They changed dramatically. The Federal Energy Regulatory Commission is fast-tracking pipelines that are needed to get natural gas to the Gulf in time for the next trains. The entire process goes upside down, and an industry that was looking stunted is now humming. We have so much of natural gas here that we can supply everyone, and apparently there'll be a lot more coming. Now, if you step back, you can see the power of deregulation, especially in an industry where there was just way too much regulation under the previous regime. In fairness, if you're genuinely worried about the environment, you probably don't want to see an explosion in U.S. fossil fuel exports. I acknowledge that global warming is a real problem, but honestly, we don't have the political will to solve it. So we might as well have a booming natural gas industry, one that gives our country a lot more geopolitical clout, especially when some of our trading enemies are still heavily into the dirtiest fossil fuel, coal. We're already seeing the benefits. This morning, Baker Hughes, the oil service company, paid $13.6 billion for Chart Industries, a company with expertise in building out these LNG facilities. It won't be the only deal there, believe me. So whether you love deregulation or hate it, you should try to take advantage of it for your portfolio. Right now, there's a lot to take advantage of, including anything LNG. I like to say there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.